The next topic we are going to examine is how to estimate ending inventory if a physical count is not taken. For example, ending inventory might have been destroyed by a fire. As has been described previously, the perpetual inventory system maintains a continuous record of the inventory balance except for shrinkage. Therefore, there is less need to estimate ending inventory using a perpetual inventory system. On the other hand, with the periodic inventory system, ending inventory is not known until it is counted. As a result, methods have been developed that are useful in estimating periodic ending inventory. The first one we will look at is the gross profit method. This method uses an historical gross profit to represent the current gross profit. Therefore, this method assumes that the gross profit is reasonably constant and that the past is a strong indicator of the present. If the gross profit for the total inventory is not constant, it might be necessary to use this method for individual products or a product mix that has a constant gross profit. The following are reasons for estimating ending inventory. GAAP does not permit the gross profit method to be used to estimate ending inventory for annual financial statements. The following is an example of this method. Assume that the company has a normal gross profit of 30%. Also assume that net sales are $75,000. If we multiply the gross profit of 30% times the sales, our estimated gross profit is $22,500. An estimated cost of goods sold of $52,500 is computed by subtracting the estimated gross profit of $22,500 from sales of $75,000. As you'll recall from Accounting 350, one of two things can happen to the $76,000 cost of goods available for sale. It is either sold, which includes shrinkage, or it remains in ending inventory. If we estimate that the $52,500 of inventory was sold, then our estimated ending inventory must be $23,500. As you can see, this method is only as good as the gross profit percent that is used. There are other methods that can be used to estimate ending inventory, and these methods are permitted to be used for annual financial statements. The next estimation method we are going to examine is the retail inventory method. This method has the added advantage of being able to approximate cost flow assumptions and the use of lower of cost or market. In the first example of the retail inventory method, the cost flow assumption we will use is average cost. The following facts will be used throughout all of our examples. We use two columns, one for the original cost and the other for the retail price of the goods being sold. The first step is to compute the cost to retail percent. We'll continue to use sales of $75,000. Subtracting sales of $75,000 from cost of goods available for sale of $115,000 gives us ending inventory at retail of $40,000. However, the problem with this ending inventory is that it's at retail. Therefore, to convert it from retail to cost, we multiply it by the 66% cost to retail percent to compute the estimated inventory of $26,400. The next example is the retail inventory method using FIFO. We'll use the same facts. With FIFO, the beginning layer of inventory will have been sold by the end of the year and won't be part of ending inventory. As a result, the cost to retail percent only uses purchases, not beginning inventory. This example is completed the same way as the previous one to find the estimated ending inventory of $27,500. The next example is the retail inventory method using LIFO. We'll use the same facts. With LIFO, beginning layer of inventory might be very old and a much lower cost than current purchases. As a result, if we combined both layers as we did with the earlier example using weighted average, it would distort the cost to retail percent and definitely not approximate LIFO. Therefore, we compute two separate cost to retail percents. When we get to the ending inventory at retail of $40,000, we see that this amount is $5,000 greater than the beginning inventory at retail of $35,000. This means that we have added a new layer of inventory at retail of $5,000. We use each cost to retail percent for both layers of inventory to obtain the estimated ending inventory of $24,438. Before we continue with these examples, there is a new concept we first need to examine and new terminology to learn. For retail operations, markups and markdowns result from ongoing changes in the prices of merchandise being sold. To illustrate markups and markdowns, let's begin with the sale of widgets that cost $6 each to purchase. The selling price of the widgets is set at $12 each. This is an initial markup of $6, but this is not how we use the term markup in our example. Next, assume that the demand for the widgets at $12 is so great that the price is increased to $15. This $3 increase is called an additional markup. This is what we mean by markup. If the price of the widgets is reduced back to $12, we call this a markup cancellation. If the price is reduced to $13, the markup cancellation is $2. And at $13, the net markup is $1. Therefore, we can say that any amount that is greater than the original selling price is the net markup. Next, let's assume that the price is reduced from $12 to $4. The $8 decrease is the markdown. If the price had been reduced from $15 to $4, we would have a $3 markup cancellation and an $8 markdown. If the price is increased from $4 to $10, we have a $6 markdown cancellation. And at $10, we can also call this a net markdown of $2 because any amount lower than the original selling price is a net markdown. We will now return to our examples using the retail inventory method. However, this time we will use net markups and net markdowns. There are two assumptions when using markdowns with the retail inventory method. The first is a change in pricing structure. What this means is that the retailer has put the merchandise on sale in order to stimulate more customer demand. This is the assumption in this first example using average cost. The other assumption, which we will examine in the next example, is that the retail inventory method is approximating lower of cost or market because of a decline in the value of the inventory. We'll use the same facts except for the net markups of $9,000 and the net markdowns of $4,000. Once we compute the cost to retail percent, this example is completed the same as the earlier ones to find the estimated inventory of $28,485. This next example uses the other markdown assumption. This method is referred to as the conventional retail method. Again, we use the same facts. This method differs from the last example in only one way. Only the net markups are included in the cost to retail percent, not the net markdowns. After the cost to retail percent is computed, the net markdowns are subtracted. By not including the net markdowns, the denominator of the cost to retail fraction is greater. $124,000 instead of $120,000, which causes the percent to be lower. A lower percent approximates a write-down of the inventory. This example is completed the same as the earlier ones to find the estimated ending inventory of $27,585. The next example is the same as the earlier example of the FIFO retail inventory method. The net markups and markdowns are included, but the beginning layer of inventory is not. Therefore, the cost to retail percent is computed without including the beginning inventory. This example is completed the same as the earlier ones to find the estimated ending inventory of $29,115. And the final example is the same as the earlier example using the LIFO retail inventory method. The net markups and markdowns are all included, and the cost to retail percent for each layer of inventory costs are computed separately. This example is completed the same as the earlier ones to find the estimated ending inventory of $27,470. The LIFO retail inventory method and the dollar value LIFO method can be combined into one method called the dollar value LIFO retail method. The advantage of this method is that it is more effective in times of price instability, which the dollar value component addresses. The first half of this method is identical to the LIFO retail inventory method we just examined. Once we find the estimated ending inventory at retail of $45,000, the second half of this method uses the dollar value method. Assuming an index of 1.05, we first deflate the $45,000 to find the $42,857 in base year retail dollars. Notice that unlike the earlier example of dollar value LIFO we examined in the last chapter, the $42,857 is still in retail dollars, not dollars of cost. We'll make the conversion to cost when we use the cost to retail percent. The next step is to compute the new retail layer of $7,857 that has been created in the current year. The new layer of $7,857 must be inflated back and then converted to cost using the 64.7% cost to retail percent. The beginning layer remains the same. Adding both layers of cost together, we compute the ending inventory of $26,338. There is no area of accounting in which overstatements and understatements are more important than those created by inventory errors. We'll begin by listing the cost of goods sold section with the correct balances. We won't use actual balances for the rest of the income statement or retained earnings. Let's look at 4 different errors to examine the effect. In example 1, assume that the beginning inventory balance is incorrectly reported as $15 instead of the correct balance of $20. This results in an understatement of $5. This also results in a $5 understatement in cost of goods available for sale, an understatement of cost of goods sold, and an overstatement of the remaining balances. In example 2, assume that the net purchases balance is incorrectly reported as $75 instead of the correct balance of $70. This results in an overstatement of $5. This also results in a $5 overstatement in cost of goods available for sale and cost of goods sold, and an understatement of the remaining balances. Notice the relationship in these first two examples. The effect on beginning inventory and purchases, which are, of course, eventually sold, have the same effect on cost of goods sold, but the opposite effect on gross profit, net income, and retained earnings. In example 3, assume that the ending inventory balance is incorrectly reported as $8 instead of the correct balance of $10. This results in an understatement of $2. This also results in a $2 overstatement in cost of goods sold and an understatement of the remaining balances. Notice that the effect on ending inventory has the opposite effect on cost of goods sold. In the final example, assume that the ending inventory balance is incorrectly reported as $12 instead of the correct balance of $10. This results in an overstatement of $2. This also results in a $2 understatement in cost of goods sold and an overstatement of the remaining balances. Let's use example 3 to illustrate another concept. What is the effect on retained earnings over a 2-year period when there is an error in inventory? Using the same facts from example 3, in which the correct ending inventory balance is $10, we see the following effects that were described in the previous slide. Next, let's look at year 2. If ending inventory is understated in year 1, beginning inventory in year 2 is also understated by the same amount. As a result, cost of goods available for sale and cost of goods sold are also understated, but gross profit and net income are overstated. How about retained earnings? The balance is correct because the understatement in year 1 is corrected with the overstatement in year 2. Therefore, in this situation, retained earnings is self-correcting. To illustrate another concept, try solving the following problem. The answer is no effect because cost of goods sold does not change and therefore net income does not change. To explain this, we begin with the following cost of goods sold section without recording the purchase or including it in ending inventory. The purchase of $5 should have been recorded and included in ending inventory. Had Alpha done so, observe that cost of goods sold would still be $80 because both the purchases and ending inventory would have been increased by the same $5. The last topic we will examine for inventory is purchase commitments. When a company wants to be certain that inventory can be purchased at a fixed price in the future, or wants to be certain that the inventory will be available in the future when it is needed in production, an executory contract is signed to purchase the inventory. An executory contract is one in which neither party has performed at the time of making the contract. Executory contracts are recognized in law, but are not recognized in accounting until there has been performance of some kind by one of the parties. In order to treat a contract as a purchase commitment, the contract cannot be legally canceled. Let's look at the following facts. The purchase commitment is for a $20,000 purchase of inventory to be made on February 1st of next year. On December 1st of the current year, no journal entry is recorded because this is an executory contract. Let's assume that on December 31st of the current year, the market price of the inventory dropped to $15,000. Even though Alpha does not yet own the inventory, a liability and loss must be recorded for the $5,000 decline in value because the contract cannot be canceled. This is similar to a write-down of inventory using lower of cost or market, but before the inventory is owned. If the inventory has declined in value another $1,000 to $14,000 by February 1st when the inventory is delivered, an additional loss of $1,000 must be recorded. The purchase is recorded and the liability is recorded as having been satisfied. Before we leave the subject of inventory, one final question remains. What if we change the cost flow assumption that is being used? To begin with, it is treated as a change in accounting principle, and the change must be reported retrospectively. The only exception is a change to LIFO, in which the change may be treated prospectively because of the record-keeping difficulty in reporting the change retrospectively. In addition, a change to LIFO requires IRS approval. A change to LIFO for tax purposes cannot be changed back for 5 years. And don't forget that any change in an accounting principle for accounting and reporting purposes requires a justification that the change is preferable for the operation of the business. In other words, businesses are not permitted to change back and forth arbitrarily without justification.